I would say in general, I've been surprised that, I wouldn't call it optimism, but there's a weird optimism. There's a group of professional investors and people really interested in the market and ideas, and everybody's looking for things to do, smart things to do, and I think the overall sentiment, everyone's sort of looking at each other and saying everyone is so negative that maybe that's a positive. Like, the sentiment is so bad, and even everybody knows the S&P earnings are too high. Everybody knows GDP growth rates estimates for next year are too high. So the question is, when is the market going to say, when is it discounted? When have you sold your securities in anticipation of that happening? And some people say, okay, the bad news, it's going to get worse, and so that's not in the market. Or it's already, everyone understands what we're talking about, and so they're positioning for the inevitable rebound. For me, for value guys that grew up with cash flows and I think value investing, there'll be incredible opportunities. I think what we're looking to do is pick through the debris and find the companies and the investments, in our case, and mostly in real estate, that they're broken balance sheets, but not broken assets. And there'll be broken companies, but broken balance sheets and companies too, that represent fantastic opportunities to deploy capital, taking a medium to long-term view. I think the question for us and for investors is, the faster the Fed goes and the more damage they do, probably the faster we wind up having to lower rates when they realize the mistakes they've made. Unfortunately, they're going to cost millions of people their jobs globally, and there's really hurting global trade. And obviously you see the situation in the UK. People are beginning to talk about Japan, their defense of the yen, and can they do that? I mean, they're putting unprecedented stress on the world. And Powell was unbelievably late doing this. He sat still while the meme stock craze was going on, and I heard about 80% of the ICOs in the crypto world have gone bankrupt, and the Fed was quiet. And now, people got employed. We should be proud of a 3.5% unemployment rate, but they're hell-bent on putting people out of work. And they're already going to lose their jobs because of what they've done already. It's rolling over. So the housing market, construction workers, construction projects, the auto workers, there won't be less demand for cars. I think the Fed is looking in a rearview mirror. You're looking at a lot of information that's old. You just look at what CEOs are reporting and look at what you'll hear in the third quarter earnings reports. You'll hear probably decent earnings in the quarter, but then I think the outlooks will change, the guidance will change, because people are so uncertain, and the currencies are creating quite a bit of volatility. And the interest rate environment means that the project you were gonna do, you might wait for more clarity. Waiting is a recession. And I think, I think the question is, how fast will rates have to fall to fix the damage? And if he does too much too soon, he could make this really bad. And I think you hear that, but I don't know. I mean, it's not our job to be equity market, forecasters, but I am personally looking for opportunities that I think represent incredibly compelling long-term investments, and I think you're beginning to see them. This is a bunch of minefields, right? This is like, you're going to hear about, that's why I'm so agitated about this, because we're creating this collateral damage. And I kind of liken it to, there were really smart things people did, and there were healthy fish in the pond, and then these stupid things people did, and they were idiot investments, and for whatever reason they called it the democratization of finance, which means you didn't have any idea what you were doing, but you were taking on professionals that did things like look at the quality of the company or the quality of the management. And so you thought the healthy fish would survive and the sick fish would die, but the Fed is draining the entire pond, so everyone's going to die. And so it's going to happen over time. You'll hear about explosion here, an explosion there, an explosion here, an explosion there, and you're literally stepping into a minefield. And the Fed, what people don't realize is the Fed has frozen the banking system, not just in the U.S., but globally. So liquidity is drying up in the banks, and then the shadow banks can feast on that, but they're also nervous. So without liquidity in the system, not only are they raising rates, but they're obviously selling bonds at the same time. It's the fastest rise in rates in history. I think I just get angry at people who said the Fed needs credibility to fight inflation. Wait, you'll get what you want. You'll get this recession. It's definitely coming. It's already here, the 2 quarters negative already, but you will see. Look what's happening. Look at Nike. Look at AMD. Look at Target. Look at FedEx. I mean, this isn't your normal market. This isn't like things are running away. And most Americans have fixed rate mortgages, so that's a good news item. They're not going to be squeezed by increasing interest rates, which is actually, I was kind of surprised about that. Most people have fixed rate mortgages. I think it's like 60% of the market. 10% have floating rate, they're going to get hurt, and 30 or 40% of people have no mortgage at all, so they won't really have any impact. But it means people can't move. If you have a fixed rate mortgage and it's at 3%, you're not going to move to a new house with a 7% mortgage, so you're going to be stuck, which is why new home sales are plummeting. I also think people are nervous, or should be nervous, about their jobs. You know, one of the funniest things, it's not a funny thing, I just have to say this because I haven't articulated it before, but I think global wealth is down like 36 trillion in the stock market, and I think the US is probably 10. Well, $10 trillion at the lowest capital gains rate was $2 trillion of taxes the government just lost, of revenue, by him raising interest rates how he has. He's cost the U.S. Treasury $2 trillion. At the same time, he's knocked rates up 100 basis points now, 300 basis points off the floor. That's almost $1 trillion of interest expense on $31 trillion of debt. So what are we going to do? We're going to print more money, and that's going to force rates up. So rates are going to drift higher without him having to increase rates any further. And the further he goes, the more money we're going to have to print to pay the interest expense on the existing 31 trillion of debt. So it's really a dangerous game he's playing, and he's killing the economy, and we'll take people out of jobs and we'll put them on unemployment benefits, and then we'll have to give them unemployment benefits when we were taxing their incomes before. Well, let's go back to the real economy for a second, because I kind of lost your question. I mean, the housing market long term is a very solid market. Both apartments and homes will be fine long term. We just have to get through this period. Apartments are occupied, rents are healthy, rent growth is still healthy in certain markets. The office markets are the question in the U.S., but there's still absorption in the office markets. I just returned from a trip to Singapore and Tokyo and Seoul, and everyone's in the office. I mean, they are back full-fledged in the office. This 50% occupancy of offices is really a U.S. thing, and I think it'll change in a slowdown. I think people, CEOs, I was listening to Sam Bankman-Fried earlier, and they're all in the office. They said, how many days a week? He said 6.5. I was like, yes, I like to hear that. But he said, you know, even for him, he said that productivity suffers when the team isn't together, especially doing creative things, and I find that we're all in the office, and I find it, you know, people come voluntarily. I don't have to ask them to come in. Well, in the real estate world, there'll be people having loans coming due. They might be hard to refinance. And so they're going to need a capital infusion where they have the money on their own. Strong players like us and Blackstone, Brookfield, you know, we have funds that can pay down debt if we need to save good assets. A lot of people won't have those opportunities. And the banks will probably look at these loans and say, we can either foreclose on these borrowers or we can sell the loan. So I think, and let someone else worry about taking back the asset. The banks aren't in the business of releasing office buildings or repopulating hotels or working on marketing plans. The banks are in so much better condition than they were in 07, 08. My guess is they won't, we called it pretend and extend before. They were allowed to do that in 07, 08. They were allowed to basically not mark down those assets to fair value. The government wanted the banks to be able to recapitalize themselves. And this time, I think the banks will be tougher, and because they're in much better capital positions and they can take the hits. But I think you'll see a lot of loans being sold. And like I said, it's all the fish. Like, it's every asset class. Every asset. There's no asset class in any industry, forget about real estate, that's immune to these much higher rates. And it's not just what the Fed is doing with interest rates, because on top of that, when we borrow to spread above SOFR, the low rate. And those spreads have more than doubled because of the uncertainty in the market. So a AAA might have priced, let's say, 100 basis point or 1% above the reference rate of LIBOR, the borrowing rate. And today that could be 250. So it's not just the base rate, it's the spread. The total cost of refinancing has gotten pretty expensive. You know, inflation in the U.S., you mentioned labor. Labor is tight, and there's still, even though the number of open jobs dropped 1.1 million, unprecedented number in the last report, which the Fed should notice, we still have 9 million jobs that are not occupied. And part of it's our labor force participation rate has shrunk. But in Europe, inflation is almost 100% the energy situation. And if you could somehow cure that, you talk about an upside. If Putin was kicked out of power and his backfires on him, the markets would have a field day. I mean, Europe would be fine. And the hundreds of billions of dollars they're going to write to their customers and their small businesses and individuals to support their energy bills in this time of crisis across Northern Europe. It's a lot of money they wouldn't have to spend. And it's put enormous pressure on those economies. And you know, our hotels in the UK, the bill was $80,000. This year will be $800,000. We put out, for the energy bill, electricity bill, we put out bids for our energy contracts, and 2 of the 7 utilities bid. The other 5 don't even want to play. So in the UK, what they did that precipitated this recent crisis is they put the pedal to the floor on fiscal stimulus by basically saying, we're going to cut taxes. And all of a sudden people say, whoa, we're trying to fight inflation. How could you try to stimulate the economy? So then the banks had to come in and say, support the pound. It's like you're being on the pedal, the brake and the accelerator full out at the same time. And the markets went, whoa, you can't do that. And this is crazy. And it is absolutely insane what they tried to do. And their timing of it in the middle of a crisis. I mean, so look, one of the most interesting things is how currencies have moved and how it will change flows of capital and how that will affect different asset classes. So for example, the pound at 110 hit, I think, 104. This morning I saw it was 110. Tourism, right? You buy a hotel in the UK, it will be full. Guaranteed there'll be a zillion people there. Americans were all over Europe this summer, and they'll be all over the UK. And they'll not only be staying in hotels, but they'll probably be shopping at all the stores and buying everything. I mean, like, nice time to buy an apartment in the UK. And I think for the people who have all the money today, which typically are the oil-producing nations, really, that have benefited from the rising global prices, and they can go on a global shopping spree. And they probably don't have a lot of competition. There's a lot of money in Asia still, but you know, the American investors, the pension plans here, they're all facing lower, you know, they've lost a lot of money in the stock market and the bond market. So they're not rich as they were. They'll still have contributions, but the real money now is shifted to the Middle East and to some other sovereigns like the new Japanese sovereign. The government right now, I think, would be good for investors. So if you have the Republicans taking getting the House, keeping the Senate, or the Democrats taking the Senate and the Republicans taking the House, or the Republicans having a sweep and you have Biden in the White House, a freeze of government doing anything really dumb right now is probably healthy for us to get to the presidential election. So I think the best outcome is probably a split Congress, and maybe they'll compromise and do some smart things and focus on things that matter to the nation instead of some of the nonsense they spend all their time on these days, including the energy policy, you know, getting solar. I was listening to a presentation today at Robinhood about, you know, how solar is so powerful as a source and so cheap that energy prices could go to zero. That was actually a presentation by Cotu this morning. Whether it's right or wrong, it's certainly exciting and something the government should definitely put, you know, investment behind. Mm-hmm. And they did a little with Biden's, you know, Energy Act or renewables bill, which I think he called the deficit reduction bill, which was really clever marketing. But I think those are important things the government can do at times like this. I'm agnostic. You know, I just think we need leadership. And I think it's a very weird time because you have politics, you have geopolitics, you have the economy, you have everything sort of in play at once. You have the China situation, U.S. relations with China. And Biden is certainly up the ante. I mean, he is definitely, whether it's the chips or Taiwan or Pelosi's visit, I mean, you have a lot of things actually that are, you know, making investors uncomfortable. There are a lot of IPOs that were done at the same time as the SPACs were doing their M&A activities. The SPAC, there were some bad actors over buying bad companies. The street was indiscriminate in who they backed. You know, you're talking about Cano Healthcare, which is a real company with $3 billion in revenues and has more than doubled its revenues since we took it public in the SPAC structure. The SPAC in itself was not a bad vehicle, but there were a lot of dumb things that got done. And they threw all the baby out with the bathwater. I have a chart of SPACs on my phone, actually, you know, and I'm watching. Everything's at $2. So some of these are $3. And some of them are really good companies, and they have great prospects. Others are frauds, and they've gone, one of them's at 7 cents, a company I passed at. I think it's 3 cents this morning. So anyway, there were a lot of bad IPOs done at the same time because the banks were trying to compete against these SPACs, and I won't name names, but there are some IPOs done at the same period that are down more than these SPACs.